Welcome to Stress-Free Investing Analysis, Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, let's jump right into this explainer and unpack a really fascinating investment paradox with Maharashtra Seamless Limited. We're going to cover their role as a seamless pipe giant, look at their fortress of a balance sheet, uncover what I'm calling the other income illusion, navigate their moats and headwinds, map out some objective valuation scenarios, and then tie it all together with a final verdict. So, Section 1, the seamless pipe giant, India's market leader. To really get what's going on here, we first have to understand what this industrial giant actually does. Maharashtra Seamless Limited, or MSL for short, is an absolute dominant force in India. They are the #1, or at least #2 player by capacity in the entire country for producing these highly critical infrastructure inputs, specifically seamless carbon and alloy steel pipes. Now, what makes their business model so incredibly durable is that they have these sticky, multi-year relationships with massive PSU buyers. I mean, a full 33% of their order book comes straight from ONGC and Oil India. It's essentially locked in. But, they aren't just a purely domestic oil play. They're actually quite diversified across the power and auto sectors, and they're exporting to over 50 countries worldwide. Now, looking at this breakdown of their nearly 5,300 crore FY25 revenue, you can clearly see their heavy reliance on carbon and alloy seamless pipes. It's almost 3/4 of the whole pie. So why does that matter to us? Well, because it puts MSL right at the absolute mercy of the cyclical oil and gas sector. Basically, when government capex and drilling flows, MSL wins big. But when that cycle turns down, yeah, they definitely feel the squeeze. Moving on to Section 2, a fortress balance sheet, the ultimate downside protection. Literally, just look at this single massive number, 2,740 crores. That is pure, unadulterated net cash sitting right on MSL's balance sheet. To put that into perspective for you, that cash pile is roughly 32% of their entire market cap. It's practically unheard of and is a true hallmark of extreme capital discipline. In a highly cyclical industry, having a cash buffer this gigantic provides an incredible floor under the stock price. It's serious downside protection. And when you compare that 2,740 crore cash pile against their total debt for FY25, which is a mere 10 crores, the debt is basically a rounding error. Management has systematically eliminated about 1,100 crores of debt over a single decade to reach a virtually zero debt status. What that means for us as investors is that they face absolutely zero bankruptcy risk. All right, Section 3, the other income illusion, uncovering the catch. Okay, here comes the twist, and this is the big aha moment of our explainer. If you just look at their reported profit for FY25, you'd think they were making a killing selling pipes. But check out this split. A staggering 61% of their FY25 profit came from other income. And what is that? It's returns from an investment portfolio stacked with gold, silver, and equities. Only 39% actually came from their core operating profit. Right now, they're practically functioning more like a hedge fund than an industrial manufacturer. And this is exactly why you have to peel back the layers of the financial onion. On the surface, MSL looks screamingly, unbelievably cheap. It's trading at a reported PE ratio of roughly 10 times. But let's be real, gold and silver don't jump 20+% every single year. When we strip away that non-repeatable investment income, the reality hits hard. The core pipe business is actually trading at a rather expensive 28 times normalized earnings. To make matters a bit more tricky, their core operational profitability is rapidly compressing back down to earth. During the absolute boom of FY24, they were enjoying these incredible operating margins of 23.4%. But by FY25, that's dropped down to 18.3%, and the trend is still heading south. The core manufacturing business is actively slowing down. Which brings us to Section 4, Moats and Market Headwinds, Navigating the Cycle. Let's map out the current battlefield. The biggest structural threat here is a flood of cheap Chinese imports. Even with domestic quality standards, this foreign overcapacity is just crushing MSL's pricing power, causing core revenues to drop for 2 years straight. Naturally, sophisticated institutional investors, your FIIs and mutual funds, they see this and they're actively bailing out.
But here is where it gets super fascinating. Right as institutions are running for the exits, the promoters themselves are aggressively buying up shares on the open market around the 600 to 664 rupee level. The insiders are showing massive, undeniable conviction.
So what do the insiders know that the market doesn't? Well, this timeline charts their potential escape route. Yes, right now we're stuck in a cyclical trough, but looking ahead to that FY26 to FY30 window, there is a monstrous government oil capex cycle on the horizon. Concurrently, MSL is rolling out these high-margin premium connections from a brand new facility in Telangana. These are premium threaded pipes meant for deep-water drilling, which carry way higher margins and should significantly widen their economic moat. And this is the ultimate bull catalyst. ONGC just announced a jaw-dropping 1.04 lakh crore capex plan to deepen domestic exploration. If the government actually follows through and deploys this kind of capital over the next 5 years, MSL's order book is going to absolutely explode. Now for Section 5, Valuation and Scenarios. Objective Outcomes. Rather than trying to predict the future with a crystal ball, let's just calmly look at 3 objective scenarios based on the data. In a bear case, if Chinese imports keep crushing margins and the government delays that capex, we're looking at a target around 360 rupees. In our base case, assuming a modest gradual recovery where that capex starts flowing, we see a target of 800 rupees. And in a bull case, if the whole cycle turns in their favor and those premium connections really boom, you're looking at a target of 1,229 rupees. Finally, Section 6, the final verdict, tying it all together. At the end of the day, we have to ask ourselves a pretty tough question. Is this just a classic value trap? Remember, a value trap is when something looks cheap on traditional metrics, like that 10x PE ratio we talked about, but the core business underneath is actually deteriorating. Given MSL's fallen core revenues, heavily propped up by a one-off investment boom, the risk of a value trap is very, very real if that oil capex cycle doesn't show up. Ultimately, it comes down to the single provocative question. Can the upcoming Indian drilling supercycle, along with MSL's new premium products, outpace the damage being done by cheap foreign imports? Their pristine balance sheet guarantees they are going to survive the battle, but whether they actually thrive, that depends entirely on this cycle turning. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.